So for today, our focus would be on interest rate risk management. We hope to cover everything we need to know around interest rate risk management with this question, which is May 2022 question 2. So we're going to read through the question, and then we'll take 5 minutes to explain the concept, and then we get right to it, which is to practice and pass. All right, so I'm just going to begin by reading the question. So it states, Mr. Big Heart is a Nigerian highly successful businessman with interests in the manufacturing, transportation, telecommunication, and aviation. He has recently shown interest in one of the La Liga league football clubs in Spain. Negotiations with the current owners of the club is now completed and price agreed. Mr. Big Heart's group of companies have been able to raise a substantial portion of the total amount needed for the purchase consideration of the club. But there is a shortfall of $150 million today, September 16, 2020. And the total payment for the acquisition must be made by December 16, 2020. A 2-month loan of $150 million commencing from December 16, 2020 is therefore being considered. The group finance director has spoken to the bankers in Madrid who have agreed to provide the $150 million needed. Given Mr. Big Heart's credit rating, the short-term loan will be at a rate of 90 basis points above LIBOR. So Mr. Big Heart is able to borrow at 90 basis points above LIBOR. Currently, LIBOR is at 6%. The bank has also suggested that due to the current economic uncertainty, LIBOR may rise by 1% or even fall by 0.5% over the coming months. With this in mind, the Group Treasury Department has been mandated to manage this risk in a manner it thinks will best minimize the inherent interest risk. The department has obtained the following data from the money and traded derivatives market. Derivatives may be assumed to mature at the end of the month. 3 months sterling futures, 500,000 contract size, 12.50 tick size. So we have our derivative for September, December, and then we have a derivative for March. Options on 3 months sterling futures. We have 500,000 contract size. We have the premium cost, and then we have details on the options. FRA prices. So we have the 3 FRAs there. We have 3V6, 3V5, 3V8, and then we have the prices for them as well. Required. Demonstrate and explain the possible ways in which interest rate risk may be managed in relation to the purchase of the club using the information provided. Based on your analysis, advise on an appropriate course of action. Your analysis should be based on the 3 derivatives identified in the scenario. That is FRA, which is forward rate agreements, financial futures, and traded options. Okay, so that's the question we would have to practice with on interest rate risk management. But before we get right into it, let's take 5 minutes to have a look at key concepts around interest rate risk management and really why we need to manage interest rate risk. Just a quick key concept for 5 minutes. Our focus is practice and pass, but it's important that we just review quickly some of the concepts for those that possibly have not studied risk management really. So when we think of the concept risk, what we're basically saying, whenever we think of the concept risk, is that likelihood. It's the likelihood that a future event might occur that would impact on our financial performance and business objective. So I'm looking at time, so I'm going to spend 5 minutes on this, and business objective. Now, the key term here is the word likelihood. Whenever there is a chance that something might happen, that is a risk. But if something has already happened or something is sure to happen, it is not a risk. So risks will basically be any situation or any event that might actually happen. And there are so many things that might happen that would impact on the financial performance of a company. However, for the purpose of our SFM exam, we're focusing on just two key ones, and those are our currency risk management and our interest rate risk management. And these are the two focus. Our practice today is on interest rate risk management. So why is interest rate risk management important? Quickly. So why is it important? It is because as a borrower, you would often be concerned about what the future interest rate would be if you plan to borrow. So let's take, for example, as if you plan to buy a new machinery for maybe $500 million in 3 months' time, and you want to borrow to provide that machinery. Now, between now and 3 months' time, you might have this uncertainty that based on the way things are going, maybe the interest rate by banks might increase. Now, when you have that likelihood of an increase in interest rate risk or in interest rate, that is a risk because they're concerned about that likelihood. Now, what of if you are an investor? You are also impacted by interest rate risks. And what do we mean by that? Let's assume that you had an investment where you had interest of, say, 20%. But then you are concerned that when that investment matures, when you're about rolling over, that the interest rate on that investment might, for example, drop to, say, 10%. That is a risk because if it drops, you lose money. So let me give you a real life scenario. So oftentimes I invest in the Nigerian Treasury bills, which is the fixed income space in Nigeria. And months before now, I would typically do 3 months Treasury bills. So I'll do 3 months. After 3 months, I'll reinvest and all of that. And that's because I had a feel that interest rate would keep increasing. But then we had Dangote's refinery come into place. The exchange rate was beginning to stabilize. Naira was strengthening against the dollar. And because of that, I had this feeling that CBN might begin to cut down on monetary policy rates and the interest on Treasury bill would begin to fall. So what did I do? I decided to transition from 3 months Treasury bill to 2 years bond. So why? Because there was risk and I had to take action. And the action I needed to take was to say, okay, instead of investing in regular short-term investment, let me transition to a longer-term one. So whenever there is that likelihood that something might go wrong, we could take action to protect ourselves. And that's what risk management is all about. So back to our question. So for the purpose of our SFM exam, we're meant to know 3 risk management techniques. They are much more than this, but we're meant to know just 3. They are, okay, we're meant to know, sorry, 4 rather. The other one is not in here in this question. So we're meant to know FRA, we're meant to know futures, we're meant to know options, and they were meant to know interest rate swaps. So at the end of this practice and pass session, you would have been able to, you would know these first 3. So it leaves you with the last one. Hopefully we have another question that has that one in the course of our practice and pass session. So let's get right back to our question down. Let's go back to it again. We said risk is the likelihood that something might go wrong. So let's go to Mr. Bickert again. This wonderful guy has a La Liga club he wants to buy. He wants to borrow, or he's concerned about interest rate. What is his fear? It says, it's stated clearly here, that due to current economic situation uncertainty, LIBOR may rise by 1% or even fall by 0.5%. That is what he's afraid of. That is the likelihood of something happening. And so he wants to protect himself. And we're asked to evaluate it based on those 3 methods. So let's begin with them, with the first one, which is our FRA, forward rate agreement. Now, whenever you have questions like this, now pay attention to how the question is structured. You would see that this part speaks a lot about FRA. So much of our attention will be there. You notice that this part is on options. You'd also notice that this is on futures. And then this is just background of the amount he wants to borrow and all of that. So this would apply to all because it's the background. However, so whenever I'm looking at FRA, I'll be concerned about the background information and the FRA part of the question. If I'm looking at options, I'll be concerned about the options part of the question and the background as well. If I'm looking at futures, I'll be looking at the futures part as well as the background as well. So let's get right to FRA then quickly. So first is FRA. He wants to protect himself against interest rate with FRA. All right, so let's begin with FRA, which is our first part then. FRA. Mr. Big Heart is considering borrowing the sum of $150 million, which is what the balance he needs for the La Liga club. And he goes and says, for me to protect myself against interest rate movement, I want to use forward rate agreement. So what is a forward rate agreement? When we set a forward rate agreement, it's basically an agreement reached between 2 parties to fix future interest rates. So for example, if it is an OTC or over-the-counter transaction, you are able to reach out to a financial institution and say, I want to borrow, as Mr. Bicard that needs to buy La Liga club, I want to borrow 150 million, but I need the money. Mr. Big Heart needs the money in December, but I need the money in December. Can we fix or agree on a fixed interest rate now for the future? And the financial market or OTC market tells you, yes, I have some FRAs on sale and you need to pick one. And they are 3V6, 3V5, and 3V8. Now, two things you must know when it comes to FRA to make a choice. One is you must know the code format. Slash the applicable FRA. And two, you must know the interest rate applicable. Okay, so let's go the code format quickly. So FRAs are often quoted with two numbers. So let me use the words X and Y. So it can be quoted X VY using V. It can be quoted X over Y. It can be quoted X dash Y. So those are two numbers. And that's why you have in our question here. They use V in this question, 3V6, 3V5, and then 3V8. Those are the ones that is V they use in our question. So what does the 3 signify and what does the second number signify? So we know what we're going to go for to protect ourselves as Mr. Big Hat. Now the first number, which is X, is the start month of your loan or investment from today. What I'm asking is the number of months. That's what I basically mean. So if we need today is what again? Today it's October 2nd, and you're borrowing November 2nd. So your loan is going to start in 1 month's time. So that X will be the start month of your loan or investment. So let's go back to Mr. Big Hat and see what the first digit would be. I think they're all three, right? They're all three. Okay, so they're all three. But let's even identify for the question and see how they got that three, because the first letter there, they're all three. So let's see how they identify all of that figure. The question says that today is September 16th. Mr. Big Hat needs a loan because he needs to buy the club by December 16th. So he needs that loan by December 16th. So when is the start month of this loan? From today. So that is September 16th. He needs the loan by December 16th, which is when he needs to buy. So let's look at that. Let's draw a line and see what that would look like. So today is September 16, which is today. He needs the loan by December 16. Start date. Okay, so a practice to pass question. So between today and December 16th, how many months? So that would be, this is September 16th to October 16th, will be 1 month, to November 16th will be 2 months, and then to December 16th will be 3 months. So that first value you would have would be 3. V word, which is the Y. Now let's define the Y. The Y, or whatever happens, so they could use V, they could use X, they could just use dash like I mentioned. So what is our Y? Our Y is the start month plus tenor or duration. of the loan or investment. Okay, so let's put that quickly. So we know that our start month is in 3 months, which is December 16. But when Mr. Big Hat borrows on December 16, for how long will he hold on to the money? That is the tenor of the loan. Let's go to our question and see what that would be. How long will he hold on to the money? It says here, a 2-month loan commencing from December 16. So he's going to hold on to the loan for a tenor of 2 months. So that is 2 months tenor. So 3 plus 2 is equals to 5. That is our Y. So we've addressed the format. And what is the format? It is 3V5. Good one. So we're making progress with that. So let's go back to the options we have then quickly. So we can identify that Mr. Bickard will not buy this. He will not buy this, but he will buy this. But we have 2 interest rates there. We have 7.08 and 7.00. So which of these 2 interest rates would be applicable to Mr. Bickard? And the rule of thumb, which is what is applicable to every financial institution, is this. Whenever you go to the bank to say, I want to put my money in fixed deposit, or I want to invest my money, versus you tell the bank, I want to borrow, the bank will always charge you a higher interest rate whenever you want to borrow. And whenever you want to invest, the bank will offer you a lower interest rate. So the rule of thumb for ICANN SFM exam would be that the higher rate is the borrowing rate. And the lower rate is the investment rate. Okay, so Mr. Bickard wants to borrow, so the higher rate will be applicable. So let's look at what the higher rate is in that 3V5 range. The higher rate is 7.08. So if Mr. Bickard could go for FRA, the applicable rate for 3V5 would be 7.08%. Now, this is our LIBOR. Let's go back to the question quickly and note something in the question. And the question says that Mr. Bickard can borrow at a rate of 90 basis points above LIBOR. In other words, whenever Mr. Bickard wants to borrow, his interest rate, whenever Mr. Bickard wants to borrow, his interest rates would be whatever LIBOR is plus 90 basis point. Now, LIBOR is what changes, because that's what Mr. Bickard is afraid of. He's afraid that LIBOR might increase or decrease. And that is what might change. That is what has the likelihood of changing. 90 basis point is fixed. So because it is fixed, it is not a risk. Because it is fixed, the risk is the likelihood that something might happen. 90 basis point is a fixed amount, but LIBOR might change. And if Mr. Bickard goes for FRA, he's going to get a LIBOR of 7.08%. So what that means is that now that we have managed or determined what the LIBOR would be with FRA, We just add the 90 basis point or the fixed element because that does not change. However, what to bear in mind is that that is basis point and not percentage. This is percentage. So just keep in mind that 100 basis point is equals to 1%. So when you have 90 basis point in percentage, that would be 90 basis point divided by 100, which is 0.9. So the total interest rate for Mr. B card, if he goes with FRA, will be 7.98%. So if Mr. Bidhart decides to buy FRA, it means that that interest rate is what he will pay on that loan. That's one of the options that Mr. Bidhart has.